Hey guys, how are you doing? Today is August 23. Actually yesterday, Peloton's stock price been rallied to 35%, right? Up 35%. And then I quickly saw some commentator change their direction, change it to buy. We know that Peloton stock price been down for 9 quarters. 9 quarters is more than 2 years, right? 27 months. It's very bad. And then suddenly, seems the performance been improved, then a lot of commentators changed their point of view and they said that are we going to change from hold, from downgrade, from strong sell to buy or strong buy, right? Is it correct? I don't think so. Because it so often does. So often does a lot of stock because they may be oversold. They may be oversold. And then suddenly the stock price rise up. Then will it change to be a good company? No. A bad company will not be changed to a good company in this way. If you change a bad company to a good company, then there is a lot of things that you need to change. Not only the slogan. So we have to know about that, right? Like PayPal or like other companies, they are not a bad company. But during the pandemic, their stock price been to sky high, and then they dropped the ban. But actually, it's not a bad company. But a bad company cannot be changed to a good company in this simple way. And a lot of stock, they dropped it for so long time. Then suddenly it has a better looking figure. Then we think that, oh, this company turned around, right? This is not the case, right? If you stay in the stock market for enough long time, then you will know, you will understand what I just saying, right? So today, then very obviously I will say that Peloton stock soars, but still not worth to buy at this moment, unless the company has a revolution on the business. Otherwise, then it's still not worth for you to buy, right? So we will follow up in the detail, right? How the figures look like. Okay, then our Falcon portfolio been 117%, right? And actually, after about more than 5 years, then our portfolio been increased to more than double. That's okay to me. That's okay to me. That means we are not perform very badly compared to S&P or compared to Nasdaq, right? We'll take a look on that, right? So for any of you, then you can leave your message under the YouTube, or you can directly email to me by Ustockmarketweekly@gmail.com. This is our covering. Then we know that what Peloton is doing, right? For some fitness, and then selling some fitness equipments. You can see that, right? Not very good. Actually, yesterday Dow Jones been dropped it for 177 points, right? But I think that's okay, right? Because it's more than 40,000 already. Finally, last step drops, right? Drops very close to 300 points, 299 points, right? No matter what, then 18,000 is not easy for Nasdaq to stand still, right? Our Falcon 350,000 portfolio, you can see that for this year, we are 13% increment already, and that's okay to me because our target for every year's average is about 14 to 15% increase on our portfolio. Of course, that not every year you can achieve it, right? But in an average, then you should achieve it, right? We can see that for 2020 year, 55%, and then next year because of the technology, 22%, and 222 also because of the technology stock crash, dropped at 30%, and last year increased by 44%. So this year then 15% is okay to us, right? This is what our target lies. We go through one or two headlines, but not a lot of news, right? Always recession. Every week, then a lot of people say that US will have a recession. We don't know. I'm not saying there is no, right? But the strategists start to saying that you cut the interest rate, but it won't prevent it from happening. I don't know. Right. It depends on how soon you cut the interest rate, or what is the amplitude you cut the interest rate. Right. If you cut it in 0.5% or 1%, then the market will have a very strong reaction. But if you cut it too late, or just a quarter, or even half a quarter, then the market will do not have a lot of response, right? I don't know. Right? In China or in Hong Kong, I think that the COVID-19 never left us, right? Still, we can see from the news a lot of COVID-19 cases in China or even in Hong Kong. The only thing, if you don't test for it, then you don't know if it's flu or it is COVID-19. We don't know, right? So actually, FDA approves updated, not the old one, the new vaccine, right? For Pfizer and Moderna. That's what it is. Actually, it never goes away. No. The pandemic been stopped in Hong Kong for a few months to go, is 2 years, but it never finished it. Every day we'll still hear a lot of cases. Even now is in China again, right? But no one tests it, so there is no COVID-19. But actually, it never ends, right? That's the news for PELOTON yesterday. The shares soar by 35%. Wow, for so long, right? And there is a turnaround plan for PELOTON. You can see that the bike and thread maker has been working to improve its balance sheet and looks to be more focused on profitability than growth. This is a new plan. I think for every public listed company, they should aim for that. Not growth is a profit. Growth is important, but profit is even more important because we need the money, right? And I don't think that this is a good turnaround plan. But no matter what, the stock price increased by 35%. So is it worth for you to buy? The answer is quite clear, no. The company shares spiked 35% on Thursday, that means yesterday, and the loss per share is 8 cents, and the market expected is 17 cents, and the revenue is 644 million against expected 631 million US dollar, and that is the reason the market is so optimistic on PELOTON. But that story isn't real, right? Then we start to look at the figures of PELOTON published yesterday. The company was not established for long, so even 5 years then covers all, right? We can see that for 5 years the stock price been dropped at more than 80%, right? And then if we shorten it for just 1 year, still drops 15.9%. We further shorten it to 6 months, then there is a positive, right? The positive is because of yesterday. If yesterday the stock price not shorted for 35%, then it's still a negative, right? But we can see that even it shorts, right, by 35% is still only 4.55 US dollar per share, right? And there is no PE ratio. This is what they are selling, right? The fitness buy, right? The fitness roll, fitness thread for running, and then the app. Then you can join for subscription, and they will teach you online, right? So some programs how you can do your fitness at home and to improve your weight or body condition, something like that. And we have to be very careful. The purple one is the pay connected fitness subscriber, right? You can see that just in 2 quarters before it's still a negative. I circled it in red, right? And you can see the trend is still going down for the purple bar. And for the pink line, average net monthly pay connected fitness chum, no change. A little bit downward, right? Needless to say, if we compare to PELOTON stock performance to average of S&P and Nasdaq, then it is quite bad, right? We look at the figures. You can see that for the total revenue, this is in a million. For the total revenue, 2.7 billion US dollar, right? For the fiscal year ended June 30. 1 year before 2.8, 2 years before 3.58, right? It's even worse than 1 year before. But the COVID is over, right? For the cost of revenue, much increased, 1.5 billion US dollar compared with 1.8 before. I tell you why, because they're cutting the shop, cutting the people. That's what it is, right? And then the loss is much improved. 2 years before, the loss is 2.8 billion US dollar. 1 year before is 1.2. And then this year is 551 million US dollar, less than half. Why this happened? Because they cut the unused shop, no profit shops, and cut the employee as well. See that the cost of revenue dropped that much because they cut the people, cut the shops. And there is restructuring expense, right? That means then you have to pay for the employee that are abundant, and then for some benefits and whatever, right? And you can see that the restructuring expense is very few now, just 6 million. That means it's nearly to the end. You see that 2 years before, 56 million, and then 1 year before, 85 million US dollar for the restructuring expense. And this year, 6.6 only. So the profit came from this way, not from the business. But we need to be very cautious. See that ending pay app subscriptions decreasing. It keep on decreasing, right? That is very terrible. You can see the figures keep on decreasing for the pay subscriptions. And the free cash flow, of course, is increased but still negative, right? Because you cut the shops, cut the employees, cut the people. Of course, the adjusted EBITDA should be improved, right? That's a must, but doesn't mean that the company is more effective. That things should not be exist. She should cut them for a long time already. It's not contributing to the profit, just taking the money from the investors or from the shareholders. We look at the balance sheet, right? You can see that for the current asset, 1.2 billion US dollar, and it's enough for her to pay the current liability, just 685 million US dollar. But hang on there, right? Hang on a minute. For the long-term debt, the convertible senior notes plus the loan add up together is another 1.5 billion US dollar. How can she pay it? All right. She can just pay half from the current asset. And then how about half? The company is lost, still a loss, not really earning money. So unless we see all these things recover, then you should not buy it, right? That's what it is. So we will see that we can see for the next quarter, no cutting anymore, because you see that the restructuring expense is nearly to the bottom. No need for further cutting the people, no need for further cutting the shop, and then already sold all the inventory at a very low price, blah 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 blah, something like that. Then we can see the true face of this company, right? After you see the true face of this company, then you should buy it. If all are okay. If not, it's not for you to buy at this time. You can see that there is still no PE ratio because still not earning money. Earn money is a lot of commentator in Wall Street, they analyze a stock in this way. Oh, the loss is less. The loss is less, then we should invest on them. It's totally wrong. We need to see the net income. We need to see PELOTON have a very detailed plan on how to change the nature of the business, and we need to see that if it is successful or not. Like the new CEO from CMG, Chipotle, to Starbucks, we don't know, right? Maybe what Brian Niccol did in Chipotle successful, but if he used exactly the same on Starbucks, maybe a failure. We don't know. We need to see, right? So no need to be so happy and immediately invest on PELOTON. See one more quarter, then we will know if it is worth or not, right? This is my comment. Okay, thanks guys for watching, and then like, comment, share are appreciated. Please subscribe and then press the bell icon next to it. So this is a Friday. I hope everyone have a very peaceful weekend. See all of you on next Friday. Bye bye.